Hello and welcome to another video as part of the technical analysis series. Today we're discussing how to use candlestick highs and lows to trade reversals. Here's the outline for the video. We'll start with a disclaimer. We'll define our terms. What are candlestick highs and lows? We'll discuss significant versus insignificant highs and lows. We'll go over a quick refresher for market microstructure. For the two types of patterns, we're going to talk about swing failure patterns, the SFP, and failed breaks. We'll cover some nuances and then hopefully conclude. Usual disclaimer, I am an idiot, I don't know anything, this isn't legal advice, it's not financial advice, it's not investment advice, it's not fitness advice, it's not lifestyle advice, it's certainly not dating advice. I don't know what this is, but whatever it is, it's for entertainment purposes only, so hopefully you're fine with that. Let's get into it. So what are candlestick highs and lows? The most simple definition is the high or low of a candlestick on a given time frame. So if you're using a candlestick chart, these are going to be the wicks that you see. Perhaps a better definition would be the extreme of a specific rotation on a given time frame. And with that framework, you can start to split this definition into sessions, days, weeks, months, and so on, which is something that will be helpful when we consider how to arrive at some of these contextual levels. Now, again, as a reminder, we're looking for extremes, so the highest high made, lowest low made, ideally at those big, obvious turning points. Now, an exercise you can do is to simply open up a chart and mark out the significant or standout highs and lows. Again, these would be the wicks. If it's too noisy on whatever time frame you've chosen, then simply go on the larger time frames, just the weekly and the daily, and the exercise should be easier. Now, I'm aware of some trading view indicators that do this for you. I'm sure they're fine. I don't use them myself. And the exercise, I think, is straightforward enough to be able to use your discretion. And again, a recurring theme throughout this whole presentation will be don't overcomplicate this. A lot of what we're going to be talking about is dependent on other market participants seeing these highs and lows and trading around them. So if it doesn't stand out to you, it's probably not too significant. So you can either pause the video and do that exercise. I'm going to jump forward and show you a quick example of what that might look like on the Bitcoin daily chart. Here we go. Just marking out the swing highs and swing lows. Again, very obvious levels at inflection points. You know, I think the matter speaks for itself. Very similar for ETH, USD on the daily time frame. Just looking at the important wicks, the ones that stand out and the ones that are built at key highs, key lows, key turning points, not in the middle of nowhere. I'm sure I've missed some. I'm sure I've added some that you wouldn't have, but the exercise, as you can tell, is rather straightforward. Again, this is the ETH example. Don't know if you want to pause on it. And this is the BTC example. Now, on to the next slide. I think we can present a more robust definition of significant highs and lows, especially given the amount of them that exist. And that's kind of the premise of the first point, that not all highs and lows are worth paying attention to. Sort of by definition, every tiny rotation will set a high or low. And so if you were on the 5-minute marking out every single swing high or swing low, that's nightmare mode. So we need some sort of filter to allow us to determine what are the significant highs and lows worth paying attention to and worth trading around. And so marking them all is useful. And if your chart looks like a clutter mess, that's as useful as marking none of them. So I think some discretion is helpful here, having some criteria for how useful they are, and we're going to go over some of them here. Now, again, our overall aim is to find the most significant ones, and these are anchors that future traders and present traders will use for their trading. And this could be for breakout trading, it could be for stop market orders, it could be for profit taking, but more broadly, we just want to see participation at those highs and lows. And as far as examples go, don't worry about it. As you can see here, we've got like 20 tabs. So thank you for all your feedback on that. And in general, thank you for your support on the technical analysis series. If you want to see more, leave a comment, leave a like. All this kind of YouTube nonsense does actually matter, and I pay attention to it. So thank you for your support. And this last section is actually very densely packed, and it's very important. And it seeks to answer the question, how do I know whether a high or low is significant? And here are some filters you can use. They're not mutually exclusive, nor is it a checklist. So bear in mind, if some of these are present, that's fine. If all of them are present, great. If one of them is present, it's probably okay. These are just some things to look out for. So the first would be time frame. So the larger the time frame, the fewer wicks or swing points there are by definition, and that makes the existing ones more significant. The second one is the eye test, that the clearer the swing, the more participants will likely use it. And we see this phenomenon in order herding and clustering in financial markets more generally. I think time-based markers can be helpful. So the high and low of a session, London, New York, Asia, whatever it may be, the high or low of a day, a week, a month, and kind of using these large candle reference points to map significant highs and lows as kind of objective anchors for the market. So if the market trades below previous day's low, some market participants might infer that the market is weaker than yesterday, above yesterday's high. That's a breakout. High of the week, low of the week. These are all things that you even see reported in financial media. So when participants look at asset prices, they like to have some sort of time anchor or reference point for the price action that they see. And so using session, day, week, month, etc. to kind of anchor those highs and lows is definitely helpful, and they'll be providing signals to a large number and a broad range of market participants. The last point is that those highs and lows formed around support resistance, or that end up forming support resistance levels themselves. And this is just further contextual confluence suggesting that the specific price matters. And so you have kind of two forms of that as repetition, so a build-up of what you'll see referred to as equal highs or lows, and participants might infer that that's kind of indicative of the strength of a level. And in general, when you have an inside day, inside week, inside month, you might look to map the high and low of that inside day, week, month, and then participants will bet on the resolution of that depending on when the market trades attempts to break down or attempts to break out. And again, the basic heuristic here before we jump into the charts is if you really need to look for it being the swing high or the swing low, and debate whether it's significant, it probably isn't. So this should be a fairly intuitive and straightforward exercise. But before we go into a market microstructure refresher, let's look at what some of those might look like. We've covered the daily examples on BTC and ETH. As far as Bitcoin on the monthly, starting very easy. This is the all-time high, swing high. You can see you got a couple of spikes of that, but no acceptance above. This is the 30K range low. Ultimately bounced a bit, but didn't lead to much. You could also use this example of the summer lows, which I think I have in other time frames, a similar kind of spike before this second high was made. And then in the context of the downtrend, worth paying attention to, you have an inside month here, and all an inside month means, not being particularly technical with the jargon, is that a candle whose price action is contained, whose high and low, and all of the entirety of which is contained within the boundaries of the previous month. So in this case, this is an obvious one. We had the new candle. This entire candle fits into the candle that precedes it. So this is a bit of a volatility contraction in a range. And so here you had a move above previous month's high before the market sold off. And another example here, an inside month. And then the last month spiked above previous month's high and then moved lower. These are all behaviors which we'll discuss, but simply in terms of mapping the market with these significant highs and lows, this might be one way of doing it. Also, this low probably matters, and I have it on another time frame. So fairly self-evident, and you start to really build a feel for it if you're paying attention and if you just stare at charts for long enough. Similar example here on the ETH monthly, a bit later, kind of in the downtrend, where you have, again, another inside month, big nuke candle, and then rally. But the rally is still an inside month contained within previous month's price action. You can see spike above previous month's high, no acceptance, traded lower. Even gave you a bit of a kind of cheeky retest on this down month. As far as this green month that we had, you can see that after this down month, it spiked previous month's low and closed up. And then most recent month, again, spiked previous month's high and spiked previous month's low while closing on a down candle. And then for this month, you might want to map out the monthly high and the monthly low and see how that resolves, while also being aware of the summer low as well. So some fairly straightforward examples there. Lots more on the Bitcoin weekly chart, very similar levels. At the first all-time high top in the 60s, you had this swing high, highest high made, fairly self-evident. Again, market spikes, finds trouble. On this occasion, you had the swing low, market just breaks through it, right? So just an example of how it's not always a perfect system by any means. If we take it to the summer lows and this nuke candle, you can see that the market tried to break through and make new lows. And that's where a lot of the soak came in before the all-time high attempt. Similar type of thing. Yeah, this weekly swing high before the final leg up ended up spiking there, unsurprisingly. And there is some backfitting here, but I'm just trying to show you examples because people ask for them before the market traded lower. And even within the context of this downtrend, again, even if you're not looking at, this would have told you it's the top, look at where a lot of momentum came from. That's perhaps the more useful exercise. This weekly down candle first spiked the high of the preceding week, and then you got the impulse lower. Same here. We have previous week's high. The market spikes that top and then closes lower. And then a kind of more generous version of this high made here. The market pushes up and tries to, it's trading in a level of resistance. But again, if we're going to have a good week, you'd expect this candle to exceed the preceding one. It doesn't. All it can do is spike its high and then move lower. from the bounce we had the Nuke candle low, market spiked that, moved up. Where did it move up into? The last summer low. So these levels are sensitive. They matter. That's my point. We're going to talk about specific entry triggers and, engulfing candles and all that type of stuff. But this is just kind of more to train your eye for looking for not only swing highs, but also those contextual levels, like in this example, keeping in mind, being aware of previous week's high, previous week's low, previous day's high, previous day's low, and then you start to build a picture of the market based on those inflection points, support, resistance, trend, and you sort of put it all together, as we will discuss, of course. Same for ETH, highest high made before the big drop. You can see the market on this occasion wasn't an obvious type of spike scenario, but there was no acceptance above that level. You had a weekly close above, dipped back below, and then everything on the backside was a bearish retest. Speaking of that same summer rally, you had the low of the Nuke candle, spike, market participants betting on new lows not being accepted, and then the market rallying. And then more recently, again, you had previous week's high being no acceptance of our previous week's high here, ended up closing red in the context of a downtrend and at resistance before moving lower. And same thing here. Where did this week's rally take us? You had a double top of previous week's high and the high of the week before that, spike and reverse. So this isn't as much kind of saying, oh, look, every single swing high is a wick and therefore you could have said it's a top. That's not all I'm saying. I'm sort of trying to make the case for at least being aware of where those previous week's, days, sessions, highs and lows are, because a lot of momentum shifts form around the breakout attempts that occur at those levels. So this is more just so you have them on your radar. BNB, again, this kind of range low, final red candle before the all-time high, got spiked here before the rally. Even smaller things here, like a double weekly bottom market. You have to realize at some point this red candle was down here, right, where the wick is. So at that point, market participants are betting on this level of support or these lows breaking. They were wrong, and you get a slight pop in the market. And then the more recent price action, all around the FTX news, I think this was, you had this swing high, spike, and then a spike of that candle, which ended up, again, the case for previous week's high, no acceptance above, that's where you got your impulse. And even smaller bounces, you can see are contextually relevant using this type of lens. We had like a bunch of 1, 2, 3, kind of triple, quadruple bottom, and then the market tried to break it, and you got a slight bounce as a result of those participants being a bit too eager. And we will reuse some of these examples. I'm trying to get as many as I can across. Litecoin, and this starts to lean towards some of the contextual topics we're going to talk about. You have a weekly level of resistance here at 79.50. Market comes in, closes below it. And so this is the high of the candle which found resistance at that level. Another test of the level, not much going on. When does the move finally happen? Well, it was after the initial high got spiked, and then a retest of the level gave you your impulse. So still very relevant. Another contextual example on the S&P 500, you have daily resistance here and a daily swing point from this high. I think this is around FOMC. Market's trading here, comes in, impulse. Where is the impulse? Well, it spikes that significant swing high into a level of resistance, and that's when the market finally moves lower. Same here, this is kind of the lowest low made initially, and as the market's rallying down and trading in this area, sort of where the wick is, you have to realize a lot of market participants are betting that this low isn't going to hold and the market's going to break down further towards 34, 33, whatever it may be, and instead you have a spike, and that was the precursor to a larger reversal. You're probably getting bored of the examples at this point, but hey, people asked for them, I'm happy to provide. A similar type of logic here, the market is puking towards its prior low and closes on a down day and actually closes below the close of the last swing point. And where does the reversal happen? This is a case of previous day's low, where the market pokes below previous day's low, closes above, so everyone who sold that breakdown is trapped, ended up moving higher, and you have similar price action on the other end of it. You have swing high here and swing high here. On the FOMC thing, where does the market come to clear out? Comes in through these highs, failed breakout, spike, whatever you want to call it, before trading lower. Some very quick altcoin examples. Again, swing high on DYDX here and here. What's kind of the impetus or the catalyst for the reversal? Well, you have a candle that comes in, swipes previous week's high and this swing point here before closing down and moving lower. And again, if you're observing this on the daily time frame or even intraday time frames, you can get a sense that the market is not being accepted above previous week's high, and that could be a trap type of setup. More recently on Bitcoin, a very kind of textbook mirror range type of setup. We have the lowest low made on the Nuke candle, market comes in, and as it's trading here, a lot of participants are kind of betting that this low isn't going to hold and the market's just going to keep puking lower. They get trapped, close above, and so everyone who's sold here isn't having a very good time. Market pushes higher. Where does it push into? Well, you have the other side of the range, the other extreme. Again, spikes, that swing point, and you get a rotation lower. I will reuse all these examples. I just really want to train your muscle kind of memory for it and your eye test. ETH USD on the daily time frame, this is a very interesting one, similar type of wick to Bitcoin. And if you see like an area of resistance to the left, comes in, finds resistance there at first, and then if you're mapping that, you have previous day's high here, and this day comes in, not only does it spike previous day's high, but it's into that same range higher resistance, closes down, and ends up giving you the puke. Actually, if you look at this intermediate type of 1300 level on the 4 hour, you have like a mini version of that, where I said, do you remember in the slides the point about repetition? Build up of equal highs or lows, participants may infer strength of a level. And so we have a good example of that on ETH on the 4 hour, which is that this cluster of highs here, 1, 2, 3, 4, market comes in, clears them out into the higher time frame level, and then gives you a backside retest of the intraday level before moving lower. And even then, you have this kind of swing point here that preceded the rally, market comes in, pukes through it, no bearish retest, isn't accepted below, and then on the reclaim, close above retest is what gave you the initial rally, the higher low before that type of rotation. Final example on BNB. Lots of technical structures here. If we go from most recent, and there's a lot of headlines swirling around at the time regarding Binance, you have a big bearish Nuke candle here that completely breaks support and clears out the range. So they see that, participants who are trading on that day see that candle and think, oh, this looks really bearish. If it makes a new low, I'm going to breakdown sell it to sell it lower. What happens instead? Previous day's low you've got mapped out, spikes below that, closes above, or ideally during the course of the day you can see absorption on the move below previous day's low, and maybe even trade a daily open strategy or any type of failed breakdown pattern that we'll discuss, and ultimately led to the move up that we're seeing right now. And same here on the repetition point, you've got support, 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 market comes in, breaks down. Is it accepted below? No, closes back above, and that's sort of what led to your initial impulse. So again, significant highs and lows. You could probably draw one based on this type of price action, but there was a news release, so I kind of left it. And again, we will reuse all these examples, but hopefully for those of you who don't watch these videos unless there's a million charts in the first 10 minutes, and I love you too, don't worry about it. But hopefully that was a decent kind of introduction. And we've covered all those points, right? Time frame, larger time frame, existing wicks become more significant from some of the monthly and weekly examples. Eye test, hopefully all of those swing highs and swing lows were obvious. Time-based, you can see how often a lot of these inflection points ended up being previous week's high, low, daily, previous day's high, low. Those are very important anchors, especially when they make contextual sense. Formed around support resistance as a confluence factor. We've hopefully seen the importance of that it's not viewing every single wick in isolation. We pay more attention to them where it makes contextual sense to pay more attention to them. And within that kind of subcategory, we had repetition, where you had obvious levels resulting in those types of multi-wick areas. And then also the idea of inside day, inside week, inside month on some of those higher time frame reversals, because those inside candles kind of present a logical range in and of themselves. So a quick refresher on market microstructure, and this is one of the more important videos on the channel. If you haven't watched it yet, please do. It's absolutely instrumental. But let's talk about the anatomy of a spike and reversal setup. So on its face, it's rather straightforward. And so the kind of behavior that we see, market spikes below a low, reverses higher, market spikes above a high and reverses lower. And again, this is covered to death in the market microstructure video and in much more detail, so I recommend you go watch that. But a classic example would be, this is our low and kind of a swing point in the market, and we can even sort of map it out as our swing low. And then the market comes in, it spikes that low, so again, the original low made, and then for some reason, some of the time, it'll shoot off and move higher. Despite looking bearish and looking like it might break down, we see this type of spike behavior at important lows, and the opposite as well of spike behavior at important highs happen rather frequently. Why is that the case? What is going on under the hood? It's one thing to talk about just the price action, that hey, it poked this, and some magic thing happened here, and then the market went up. But what's actually going on? And microstructure does give us a decent basis for analyzing that type of behavior. And so what happens is the following. First, the market spikes below. We're going to use the bullish example just because it's easier. First of all, the market spikes below a low, right? And two things happen, or I guess two forms of the same thing, is that a large amount of sellers, or specifically a large amount of orders to sell, begin to execute at a similar price and at a similar time. Now, who might those sellers be? I think they broadly belong in two categories. One is the fresh sellers looking for momentum continuation, and the second is previous buyers closing their longs. So if we apply that to our squiggly diagram, when the market looks like this, you have fresh sellers who, again, like in some of those examples, are arguing, look, this low is broken, support is broken, so I'm expecting this. And so as the break starts to come in, anything below that low, they become sellers. And in the same vein, if you were long anywhere in here and using this swing low as your invalidation, because maybe you thought the market was going to make a higher low, maybe you just thought it was going to be an uptrend, but you use this market structure level for a stop for your longs, if the market invalidates you and you're long, you have to get rid of your long. How do you get rid of your long? Well, you have to sell, right? You bought contracts, you have to sell them in order to get out of that position. So suddenly, as we're down here trading through this low, you have momentum continuation sellers who are betting on this, and you have existing longs who are just being invalidated because they use that specific low as a stop loss for their bullish idea. And so as a result, you have a lot of sellers come in at the same price at the same time. So that creates a large demand for liquidity, that is to say, for buyers. Now, those sellers are providing liquidity or trade with a larger buyer who's able and willing to absorb the sell pressure. Because by definition, if a bunch of orders are being executed below this low, right, as the market's here and a bunch of people start selling, if no one's willing to buy it, then it's just going to keep moving lower until it finds a level of buyers to fill their market orders. Because again, market orders are immediate demands for liquidity. So the market will move as far as it has to before those orders start getting filled, even if it's kind of crazy displaced and ends up being a large move. So the fact that it gets absorbed or stops or kind of consolidates or pauses here means that despite the large amount of sell orders coming in from those momentum sellers, from those invalidated longs, whatever it may be, someone or something is soaking it up, right? And that has to be buying, because every buyer needs a seller, every seller needs a buyer. So if there's a lot of selling in the same area at the same time, there has to be a sort of large buyer to stop the price from skipping that price and moving much lower. So someone's on the other side of it by definition. A buyer who's able and willing to absorb the sell pressure. Now what happens next is, by virtue of that absorption, the breakdown has failed, so the market doesn't follow through, and it starts to reverse as those larger buy orders have been filled, right? And those same participants we described earlier, they're trapped and they're forced to act. So the momentum continuation sellers have to close, which means they're forced to buy back. The reversal traders, like you, me, and other traders who punt these types of setups, they pile in long, having seen the failed breakdown and inferred that there are trapped sellers below that low. Some pre-breakdown buyers also potentially buy back their positions, realizing it's a spike and they've just had the short end of the stick there. And it's a combination of the above to varying degrees. So the simplest explanation would be the participants tried to force the market lower and failed, and trap traders act as fuel for reversals. So hopefully that gives you some sense of, sometimes the market just pukes, there's just a lot of selling and no one's willing to buy it, and the market will travel until it finds those buyers to fill the demand for liquidity from the sellers. Other times the buyers are more than happy to provide it and in fact wait for those types of opportunities before the market reverses. So yeah, very active sellers not getting their way, being soaked up by passive buyers, and voila, traders just make things worse by buying that type of setup, and so those sellers are not in a good position. And shorts closing end up being longs, especially if it's in an urgent state and they act as fuel, especially if liquidations get involved. You can kind of start to see where this is going. Now, the swing failure pattern, or as it's known, the SFP all over crypto Twitter, this is a specific price pattern articulated by Tom Dante. I would just tell you to go purchase his webinar on it for the detailed reasoning. I think he's been trading the SFP longer than I've been trading full stop. As ubiquitous as it is on crypto Twitter, most people misapply and mislabel it. So if you want to learn from the person who's coined it and still trading it to this day, I just go find it, look it up, buy it. But the premise is the following. Essentially, it's a spike and close below a key high or low on a given time frame, and that acts as evidence of a reversal. And it's using that exact same logic we covered just 2 minutes ago, that in the bullish case, the spike, you'd expect to see a spike below a swing low and close back above it, as in the example. That's a failed breakdown, so the sellers are trapped and the market's going to move against them. And the bearish example, a spike below that should say a spike above, apologies. Spike above a swing high and close back below it, which indicates a failed breakdown. And the invalidation for that would be the top or bottom of the spike. Obviously, if you're bullish, it's the lowest low made. And if it's a bearish example, it's the highest high made. So ordinarily, I think we have some of the chart examples here. I mean, this isn't the worst example on the daily time frame. You have, this is one as well. This is sort of one. This is one. But you can see the logic is rather straightforward. You have a level, market comes into it, spikes above it, close below, and that's your swing failure pattern, even though it's probably not the best example. Here, another one, you have the swing point, market comes in, spikes above it, close below, that's the swing failure pattern. And your invalidation would be the highest high made, if it's the bearish example, or the lowest low made, if it's a bullish example. I'm wondering if there are any specific SFP ones that are slightly better than this, perhaps on some of the lower time frame stuff. I would say this is a good one as well. Didn't kind of retest the level, very straightforward. Came into the level, spike above, close below. That's the swing failure pattern. You can see it's not always super straightforward. The market can come back and retest that level, but those are kind of nuances we'll account for at other points. This as well is technically valid. You have a deep swing point, even a double bottom at this point. Market comes in, spikes below, closes above. That's your swing failure pattern. And again, invalidation always on the lowest low made if you're bullish, highest high made if you are bearish. Yeah, this probably isn't the worst. This is going to be a tricky one because it's around FOMC. This is probably a better one. You have a very key low because this is the low of the entire downtrend. So a lot of traders are going to be betting on trend continuation. Instead, you have a move below, close above, and, larger move to follow. I think Tom actually liked the one on Bitcoin. I hope I've got it. This one here, this is probably the best one. Again, these setups are really good at extremes, and by definition, the lowest low made so far in a strong trend, especially after a big breakdown, is always going to be contextually relevant. So you have the low, market comes in, spikes below, closes above. That's your swing failure pattern. Invalidation at the low. Entry can be on the candle close. We'll discuss entry triggers in a bit, but just for this pattern, it can be on the candle close and sometimes on the retest of the level, but sort of the orthodox version, as far as I'm aware, is as soon as it spikes below, closes above on the time frame of the swing high or low that you're trading, that's a valid entry trigger. And the same for the swing high here again. Spike above, close below, that's when the swing failure pattern becomes valid, in my understanding. And again, the logic is the same. It's basically the market microstructure refresher. You have traders trapped below the low, market moves against them. Traders trapped above the high, market moves against them. You can articulate this in a million different ways. It's buy-side liquidity, it's sell-side liquidity, it's stop hunting, it's spikes, it's deviations. But the price behavior is what's important, and that logic stays the same throughout. The market tried to do something, it failed at doing that thing. The people that tried to do that thing are trapped, and the market's going to move against them. Whatever fancy terminology you want to use is fine. I'm hoping to convey the concepts so you can sort of think for yourself on those terms. Now, as far as this type of pattern goes, as I said, invalidation is quite clear. It's the extreme, which is nice because it generally gives you pretty good risk rewards unless the wick is crazy. I will say on the target, it depends. As far as I'm aware, Tom uses ATR-based targets and some contextual stuff. The reason I say it depends is because, I'm a discretionary trader. I'll never have it's rare that I have a mechanical target. But here are some ways you can think about it and play around with conceptually. So if you have a high time frame bias in play, which is to say, let's say you have an hourly SFP, but you have a daily or weekly bullish signal, then you'll generally target a larger move because it's not just the hourly pattern that's playing out, but it's the hourly pattern in the context of a larger dominant trend, right? So if I have a daily bullish bias, an hourly bullish SFP, I won't be selling that at hourly resistance. I'll be looking to sell that at daily resistance. Hopefully that makes sense. Generally speaking, if you want like a rule of thumb, your target will be the FTA, the first trouble area, which is the nearest support resistance structure on that time frame, as long as the risk reward makes sense and meets your trade criteria. I thankfully do have an FTA video on the CryptoCred channel. Go look it up. I think it's literally called FTA and covers this concept to death. You can also pick your targets somewhat contextually. So in a range, it can be the midpoint and the other side of the range. In a trend, you can target trend continuation, so higher high if it's bullish or lower low if it's bearish. And again, as usual, some combination of the above to varying degrees dictated by context. Now, a common critique of the swing failure pattern or SFP is that there is an arbitrariness to using candlesticks for the specific purpose of the SFP. Like, as you'll recall in a lot of these examples, the necessary condition for the pattern is a spike below and a close above. But obviously, if you change time frames and the time periods change, then perhaps on one time frame it looks like a spike below, close above, but on another time frame it looks like a close below and close above. So it doesn't meet the spike and close requirement. Does that mean the SFP isn't valid? And it's a totally reasonable question to ask. My view is the following: it doesn't matter the exact time frame and the exact candlestick, spike, close, whatever, as long as you're consistent in your application, such as the time frames that you trade the setup on, and also that price is unfolding in accordance with the logic of the setup. Like, the setup works not because of some candle, wick, close, whatever. It works because traders are trapped below the low or trapped above the high. That's the important mechanism here. And sometimes that will be neatly and elegantly reflected in the candlestick and the time frame you're using. Other times it won't. So that's why I'm kind of drilling down the first principles here. So even if it's not the picture perfect SFP or failed break or trap setup on the time frame that you want, if you understand the logic of price, you'll be able to trade the setup. I will say, in defense of using specific candlestick or time-based stuff, is that it just makes trade identification and execution easier to systematize. You know that you have to see on the hourly a spike and a close, and if you don't see that, you don't trade the setup. Now, yes, sometimes that will leave you with missed trades where all the price stuff unfolded, and just because the candlestick didn't work and wasn't on one time frame and not the other, you miss out on the trade. That's okay, but it is still a benefit of being stricter with it, that it's systematized and it's very clear whether you take the trade or not. I would say also another benefit of being slightly stricter with your timeframes and sort of conceding the arbitrariness is that it helps to mute some of the timeframe noise that you see. So, for example, a 5-minute SFP of a daily low could just be the early portion of a breakdown, and you're there staring in the face of a nuke candle, and you're like, but look, the 5-minute closed below and spiked below and closed above. And if you really mismatch your timeframes, you sort of arrive at very premature conclusions much of the time. So, sort of using a specific time frame for the setup smoothens out a lot of those idiosyncrasies. Now, at its core, again, it's the principle that matters. You're looking for a lack of acceptance through a significant high or a lack of acceptance through a significant low. And there is a kind of clear case for not being too tied up in the specific candlestick mechanics, because footprint traders punt very similar setups without reference to specific candlesticks or timeframes. They'll just look at the delta, look at the footprint, look for heavy-handedness that doesn't go anywhere, and the logic of the setup is the exact same without having to revert to or resort to candlesticks. It's just a question of what's happening above the high or below the low. We can even correct that slightly. The low. There we go. Okay. Now, failed breaks, and we're kind of zooming out a little bit. If we take SFPs, generally they resolve quickly, and it's best to think of it as a sort of hit and run, spike and reverse type of setup. As we saw in a lot of the examples, if the SFP is going to be correct, it won't spend a ton of time at the level itself. I mean, this is potentially one on the EVE 4-hour. You have a swing high, market comes in, spikes it, closes below, and then woof, teleports, right? Similar example on BTC and, hold on, where was that? Yeah, similar example of BTC, spike below, close above, doesn't waste any time, next day up, pull back, and then continuation, right? Same thing here. Spikes above, close below, next day, just rugs. So SFP setups at their core, and this is one of the benefits of trading them, is that they generally resolve quickly. And if your SFP isn't moving quickly, then it's probably not going to be the best setup in the world. Because by definition, if you've really got your hands on a trapped trader setups, those trapped traders are by definition forced to act. And that urgency is reflected very obviously in the price chart by large moves. And if there is no urgency and there is no large move, then how trapped are the traders really if the market hangs around their entry the whole day? The entire logic is that they have to act. They're underwater. They're going to close their positions or rebuy if they're on the other side, whatever it may be. If the market's just kind of spikes and does fuck all, then there's no urgency and there's no trapped component, and that reduces the probability or just appeal of the setup more broadly. Something worth bearing in mind. Now, while SFPs are one type of failed break, not all failed breaks are SFPs, nor do they resolve instantaneously. And so it helps to have like a zoomed out perspective on what we're looking at here of the market showing an unwillingness to accept prices above a key high or below a key low. And sometimes that can take time. So in some of the examples that we've covered, especially on the higher time frame charts, it was by no means an instantaneous process. I think in some of the earlier examples specifically, let's look at this. I think I've got better ones. Hold on. Yeah, so this is a good example. I mean, this ETH weekly range is a good example. If we look on the downside, the market came in, spiked this low, closed above, but moved up, but didn't do much. And then it came in again and spiked previous week's low and retested that same original SFP level before then giving you the impulse. So, and that's quite that's like a month of price action there. Now, while technically the setup at its core is the same of participants trying to sell through this low and not having any luck, you can tell that based on this time frame and this specific pattern, it wasn't like an SFP type of hit and run setup. It took a bit longer to resolve. A nice little previous week's low confluence on this one as well. Same for the top side. This wasn't the case of it, spikes above, close below, and then you sell it. If you did that, you wouldn't be having a great time. However, the trade logic or the setup logic ended up being the same, just resolved more slowly, because ultimately the market never accepted above the swing high, as we discussed. Close above, and then close below 2 weeks later, and then that starts acting as resistance before you got this kind of cyclical turnaround. Now again, the logic of the setup is the exact same. Buyers tried to buy through the range high and weren't successful. Sellers tried to sell through the range low, weren't successful. But unlike the SFP setup, this is a broader conception of a failed break because it didn't resolve as quickly. Similar-ish examples on this kind of BTC range low here, where you had the nuke candle low, market comes in, close below, spike below, close above. If you traded that, then you're sort of immediately underwater. But ultimately, if you take this consolidation as a whole, you have a key low. It just took longer to resolve. Market tried selling through it. Again, previous week's low confluence, and then you get your impulsive type of move. So that's something worth bearing in mind when dealing with failed breaks more broadly, is that they don't have to resolve instantly if they're not SFP type of style. It's fine for the market to actually try to break the level, spend a bit of time above it. And the more important question is, not is there a wick or is there not a wick, but is the market able to accept above the range high or accept below the range low? And when that answer becomes no, then any type of failed break setup becomes actionable, even if it takes a bit longer than we'd like. And it doesn't have to be an instant reversal to be a failed break type of setup. And yeah, as I said before, the underlying logic is the same. Buyers tried to force the market higher at a key level and weren't successful, or sellers tried to force the market lower at a key level and weren't successful. And their aggression, those large deltas, market orders, provide the fuel for reversal. And you can start to piece together a lot of the price action concepts you've seen when it comes to reclaims or deviations or over-under setups. It's the same thing. It's just a failed break. In support resistance terms, it's back above support, it's support again, back below resistance is resistance again. So for example, when you see your textbook type of premise of a deviation, let's say this is your support and the market does this and then breaks above, you'll have a lot of commentators saying, well, this is now, this portion was a deviation now that the market has reclaimed this level. But what really happened is the market tried to break lower, that portion of price wasn't accepted and ended up in a reclaim with those sellers trapped. Sometimes it's instant if it's SFP, sometimes it takes longer if it's a deviation. Maybe it's a failed support resistance flip if we really want to start making stuff up. But at its core, it's the same thing. Break lower, market not having it. Break higher, market not having it. And how long that can take can simply vary. And it's okay. That variance is okay. Failed breaks 2. One of the main benefits of trading SFP or failed break setups, as we've discussed at length, is the predefined invalidation. So usually in the bullish scenario, it'd be the lowest low made, and in the bearish scenario, it's the highest high made, the sort of excess of the move. And so when you're considering whether there's a failed break type of move forming, or whether there's been a deviation or what have you, it's a two-part formula. Part 1 is price making an effort to break through the key level, i.e. trading through it or spending time above it. And part 2 is price failing to continue and therefore moving back within its boundaries. So again, if this is our level, if it's an SFP type of thing, that entire process is quick. It tries, nope, not having it. And sort of that's where the trade That's what the trade idea looks like. If it's just a failed break more broadly, it's okay for the market to take longer. And you have a fight between buyers and sellers at the level, and then when it does that, one side definitely lost, and it's the sellers, and they still end up acting as fuel even though the setup took longer. But the logic ends up being the same. Part 1, an attempt to break through the level. Part 2 is no acceptance below that boundary. Now, whether that happens instantly or happens later, it doesn't matter. The trade logic and the forces at play are the same. As far as entry triggers go, thankfully now I can say watch the entry triggers video because it's a good video and a lot of the same principles are applicable here. Generally speaking, for failed breaks, and again, this isn't conclusive by any means, I think the entry triggers video covers more, but some to consider are the following. You can have a close below to close back above, or close above to close back below on the relevant time frame. So quite simply, in some of our examples here, if we take, hold on, I want to get some of the better levels on this one we had. Yeah, I mean, the ETH one is a really straightforward one. You had a close above the level here. This next week was whatever, and then you had a close back below. So that's a classic example. And then your entry would be anywhere at the level or even a market order, invalidation at the high, and that's the idea in a nutshell. Other examples in terms of levels, I want to see if we get any really clean ones. Close above, close back below. I mean, I cover these on stream all the time. I think the ETH one might be the only one I've got available in this specific catalog. I mean, this actually isn't bad for ETH. Yeah, that's it. I knew I had one more example. So this one on ETH is good, where we had this quadruple top and also some, it's also a 4-hour and daily important swing point. And we know there's a lot of stuff going on here, but just taking this lower level, you had a close above, a sweep, swipe, spike, whatever term you want to use, all you're describing the same price action, and then a close back below that same level. And I kind of used it mapping the initial high, or mapped it using the initial high, but you can use any of these similar structures. Close above, close back below. These guys are trapped and and on the wrong side of the move, and that ends up being your impulse. So that's just one specific entry trigger, the most straightforward one. Thankfully, I've just now remembered there is another video on my channel, which is horizontal support resistance setup, clean double close or some made up shit like that. But that exact video is a bit old, but it covers this type of logic where you have a clear level, market closes below it, and then closes back above it as a valid entry trigger. Here we go. God, I just forgot what my examples were. This is a good one. You have this triple, quadruple bottom on BNB, close below, looks like a break, close above, evidence that the market wasn't accepting that break, invalidation at the lowest low made, and target whatever contextual level makes sense. In this case, it rallied all the way to the range high to spike it. So again, very straightforward as far as entry triggers go, just candle closes on the relevant time frame. That's definitely worth investigating. Another one, which is again related to the first one, but reclaimed level back to acting as support after breakdown attempt or resistance, back to returns to acting as resistance after the breakout attempt. So basically the level restoring its original purpose. So just like in our squiggly example here, if this was our support, evidence of a failed breakdown or entry trigger will be once the market gets back above, it starts finding support at that same original level where it formed the low initially. So that can definitely be a useful signal. I mean, this is probably the more straightforward one that we have available. This 4-hour low on ETH, break below, market doesn't go anywhere, right? So that there's some sort of soak absorption going on, and then ultimately closes back above, wicks back to this level, finds support there. That level's been reclaimed now. Invalidation, at the low if you want to be safe, or maybe even a thrust candle stop if you're cheeky, and then target again, very contextual. I'm wondering if there are others. I mean, this is decent enough. Again, it's based on that ETH 4-hour structure, but looking at it on the daily in terms of this range high and this swing point in general, you had a close above, close back below here after a spike, and you can see the market retested that level before moving higher. So it was resistance, that's the spike, back to resistance, and that's the important part of that, I think. Is there anything else structurally that's particularly helpful? I don't think so. That's probably the core of it as far as that entry trigger goes. And in general, even if you're not using price-based stuff, you just want to see a large amount of delta or aggression through the high and low, and price trading above that cluster if you're using the footprint, right? So I'm sure go to Adam's videos and blog, Trading Riot, and he covers a ton on what these kind of mousetrap and failed break setups look like. From a footprint point of view, they're really good, but very much looking at the same thing of you want to see a large amount of participation that goes unrewarded, and as soon as the market starts trading above where the sellers tried really hard or below where the buyers tried really hard, any entry trigger at that point is valid, whether it's a market entry or some sort of retest entry or a momentum entry on a consolidation or some sort of daily open flip, you know, candle close, you name it, it's the kitchen sink at that point. Now, there are some very important nuances when considering these types of spike, reversal, setups, what have you. Now, I call them trap setups as a catch-all term, and I would say that they are important in the context of the dominant trend. So in a downtrend, when things are bearish, you would expect failed breakouts more than failed breakdowns, because in a downtrend, it's less likely to be a failed breakdown and be a real breakdown because the trend is down and stuff is moving down. But when you see a breakout in a downtrend, you should raise your eyebrow because that's a counter trend move, and therefore, in your mind at least, you should entertain with a higher probability that the breakout is going to fail. And obviously, the opposite works for an uptrend, which is bullish. In bullish conditions, if you see a breakdown, you should treat that with suspicion that perhaps that is a catalyst for a continuation more so than a real breakdown. So trading sort of, you know, the old slogan in tandem with the trend is actually relevant when considering trap type of setups. You definitely don't want to be the counter trend maximalist who in every uptrend fades every breakout and every downtrend fades every breakdown. That's a very easy way to not have a great time, to put it charitably. Now, within a range, forgetting the context of a dominant trend, within a range, you want to look for trap setups at the extremes or boundaries of the range, and the basic logic applies of a failed breakdown at the range low, more likely to reach for the range high, a failed breakdown at the range high, more likely to reach for the range low. So one extreme to the other, essentially, and that's, as we indicated, I mean, this BNB one is like a decent example. A failed breakdown at this range low and led to your range high and then back down. On the Bitcoin front, this was a good one where you had a failed breakdown at the range low, ultimately took you to the range high. And so when you're dealing in range-bound conditions, those, generally speaking, those should be your targets from one extreme to the other, regardless of the sort of time frame you're engaging in. Same here. Right, you have a spike. I mean, this is a really unfortunate example, given this candle would have probably taken anyone out. But if you were quick enough to catch the previous week's high, whatever it may be, you know, range high, range low. Once the spike comes in and fails, ideally some sort of, you know, visible on the lower time frame, where does it ultimately get to? It gets to the range low. Do I have other range bound examples which aren't crazy? I don't think so. I don't want to go like, you know. I guess this is somewhat valid. I mean, we're sort of talking about it at the time. Here you had a range high spike. Where's the range low? Well, it's at the very least here, if not lower down. But I think the more important point is to take away the fact that when we're dealing with inside days, weeks, and months, that in itself is also a range. So, for example, if you have this as your inside month, no, that's a bad example. Let me just do this on the squiggly. Do I have any examples? Yeah, sorry, this is a good one. So if you're dealing with the inside range as a month, let me try that again. When you're dealing with an inside candle, its boundaries become the range. And so when you have spikes of one side of the candle, that's the range high or the range low, right? So on this occasion, this is the inside month. The range high got spiked. The natural target is the other side of the range, which happens to be the inside candle low. So when you get inside days, inside weeks, inside months, and the market spikes one side of that candle, you naturally target the other side of that candle. Whew, I really butchered that, but I think we'll keep it in, whatever. Raw and unedited. But yes, any type of range, whether it's your standard price action one or a specific inside candle type of range, from one side to the other, once a failed break has taken place, is your baseline expectation. I would also warn you in this, because listen, whenever this certainly was the case for me, whenever I learned a new tool, I just jumped into the first 1 minute chart and tried to use it and find every use case for it. This is especially important for trap setups, is that not everything is a trap setup. Sometimes the market just breaks higher or breaks lower and keeps going, and that's normal, especially when there's a dominant trend intact. Can you imagine if the market just worked on these types of spikes and failed breaks? I mean, the market would literally never go anywhere, right? You just have like the same range, and it's like, oh, spike one side, spikes the other side, spikes one side, spike the other side, and the market would be garbage. And as we've observed, the market does trend and have a directional bias from time to time. So it's not all traps, it's not all spikes. Contextually, you can, again, start to make a really strong case for where you might expect those to form, like, in tandem with the trend or specific range boundaries. You can sort of zero in to where you might expect them, but not every time the market trades through a wick is it the end of the world, mega reversal incoming. So I think, having a good filter, and we discussed some of those steps, having a good filter and good context for where to find significant versus insignificant spikes is going to save you a lot of money, because otherwise you end up doing business at every single wick, and it's just not a good time. I will say also, be proportional when considering timeframes. Now, if you have a daily failed setup or failed breakdown or just some sort of daily trap, it's likely to lead to a big daily move, as we saw in the Bitcoin example. If you have a small 15-minute trap, it'll probably lead to a smaller did I say $15? Oh my god, I'm talking about my bank account here. If you have a smaller 15-minute trap, it's more likely to lead to a smaller 15-minute move. And if you have now what doesn't make sense is having a 5-minute spike, for example, and then expecting a weekly reversal on the back of that. So I think, again, this speaks to the strength of the SFB specifically. It kind of keeps you grounded in terms of timeframes, but just be aware of the types of spike or trap or SFB setups you're dealing with, and make sure they're somewhat proportional when it comes to the type of move you're expecting. Higher time frame, bigger move; lower time frame, smaller move in general. I would say for this type of setup and just thinking about the market in this way, that confluence is very important. So a random high or low that barely stands out is less likely to be compelling than a clear high time frame high or low, which also aligns with an SR level, moving average, round number. Like, you should be able to build a story almost of the market, or sort of make it compelling as to why that inflection point is significant out of the thousands of highs and lows available when viewed through the lens of a candlestick chart. So factors of confluence, whether it's support resistance or candlestick opens, or daily, weekly, monthly highs and lows, moving averages, round numbers, all that kind of stuff adds significance and increases the probability of you landing somewhere important as opposed to in the middle of nowhere. And again, the last point, very important, but also very simple: pick better levels to get better trades, even if they don't form as often. As we covered at the very outset of this video, the logic of these types of setups is based on active participation in the same area. If it doesn't stand out to you, if it's not obvious, and if the sort of swing point or key high and low you're looking at, you just kind of lose track of it when you take your eyes away from the chart, it's probably not that significant. And if it doesn't stand out to you, it probably doesn't stand out to the rest of the market, and that's doing you no favors in terms of doing business at good levels. Conclusion, that's it, we're done. Before you go, I would really appreciate it if you do normal YouTube stuff. Just while I'm rambling, click a like on the video, subscribe to the channel if you haven't already, leave a comment about something ideally relevant to the video, but personal insults are also acceptable. There's a lot more content on the way. I want to get this one out of the way because it also pertains to some of the videos that came before it. So it's a nice little topic to round up on before we venture elsewhere. I would also ask you to check out Technical Roundup, where I do live streams and other stuff, and the free newsletter, trletter.com, which comes out every week, where Donald and I just post levels and analysis. If you want more up-to-date market stuff, that's where you look. That's all from me. Hope you all have an excellent day, week, life, whatever the relevant time period is for you. Thank you for your support. More coming, and that's all from me. Take care. Bye-bye.